Hello and very warm welcome to the sessions on Indian economy. So we were discussing the definition of GDP and the concepts associated with it. I hope you can recall the definition that we have discussed, that the total value of final goods and services, total value of final goods and services produced in a domestic territory of an economy. Total value of final goods and services produced in a domestic territory of an economy. Domestic territory of an economy, right? Over a period of a financial year, right? Over a period of a financial. Now we have discussed this. We have discussed what are final goods and services. We have discussed what do we mean by production. We have discussed what why we are including values of goods and services, domestic territory, and financial year. These concepts we have discussed. Then we talked about the depreciation concepts, right? What is depreciation and how on the basis of depreciation we get two variants of GDP. One is GDP and one is NDP, right? Net domestic product, right? If we subtract depreciation from GDP, we get what? NDP. If we subtract depreciation from GDP, we get NDP, right? This is what we have discussed. Then we have talked about net indirect taxes also, right? This is also one of the concept that we have discussed, net indirect taxes. What do we mean by net indirect taxes? That we have discussed that we can have GDP at factor cost and we can have GDP at market price. GDP at factor cost and GDP at market price, right? For example, we have seen if we want to have GDP at market price and we are having GDP at factor cost, then we can add net indirect taxes to it. Add net indirect taxes to it, we will get GDP at market price. This is what we have discussed in the last class. Then we have also talked about GDP at current prices and GDP at constant prices. So GDP at current prices, also known as GDP at current prices, also called as GDP, nominal GDP. Nominal GDP. This we have discussed under the concept of base year. So when we use concept of base year, again we are having two variants of GDP, that is nominal GDP and real GDP. So real GDP is also called as GDP at constant prices. At constant prices, or also called as real GDP, nominal GDP and real GDP. And here we got a term related to GDP deflator, the term known as GDP deflator, which also accounts for inflation in the economy. So GDP deflator is nothing but nominal GDP divided by real GDP. Nominal GDP by real GDP into 100. Right? This is what we have understood. So these are basic concepts related to GDP that we should understand. Now moving forward with another concepts and definitions, one of the very important topic in GDP, that is calculation of GDP. So there are three methods that we can talk about if we are talking about calculation of GDP. One is known as expenditure method, and one is known as income method, right? Income method, and one is known as product method, also known as value added method, also called as value added method, right? We have already seen how value addition takes place, right? When we are subtracting the cost of input from the output, right? So from output, if we are subtracting cost of input, that gives us what? That will give us product method. Now when we are having these three methods of GDP calculation, let's talk about expenditure method. But before that, we have to understand one concept. Since from the concept of circular flow of income, if you can recall what kind of flow that we have seen in circular flow of income, there we observed that whatever is the expenditure of one sector will be the income of the other sector. So total expenditure in an economy, right? We can equate this to total income, right? And whatever income and expenditure is happening in an economy, we can equate this to total production. Can equate this to total production, right? So in GDP, we want to understand what is the total production in an economy, right? The definition of GDP just now we have seen. So we are focused on total production in an economy. So as you can see, total production is equal to total income is equal to total expenditure. So these three terms are same, right? We can equate these three terms. So that is why total expenditure is equal to total income is equal to total production in an economy. So if you can measure total expenditure in an economy, that will also give you what? GDP, right? GDP of that particular economy. If you can calculate total income in an economy, then total income in an economy will represent total production in an economy. Different variants can be there. For example, if you are calculating total income, right, then you will be getting GDP at factor cost, because income is at factor cost, right? So that's how some differences will be there with respect to different variants, but we have seen how different variants can be converted into other variants, right? That is what we have already seen. So let's talk about GDP at expenditure method, for example. So we have seen how many sectors are there in an economy. So household is one of the sector, or we can write it like this: household is one of the sector, right? And then we have firms in the economy, then we have government in the economy, right? And then we are having external sector as well. We are having external sector as well, right? This is the kind of uh, uh, sectors we are having, right? Households expenditure, one is households expenditure, also known as consumption expenditure, also known as consumption expenditure. Then firms are also making expenditure. When household is making expenditure, they are making expenditure on consumption, they are making exemption on expenditure on consumption. So we are calculating basically here GDP by, we are calculating here basically GDP by expenditure method. Expenditure method, right? When we say GDP by expenditure method, this is consumption represented by C. We also call it, more precisely, we call it private final consumption expenditure. Private final consumption expenditure, right? PFCE, private final consumption expenditure. But as of now, let's call it consumption only, right? Let's call it consumption only. So private final consumption expenditure, this is more precise term that we use for consumption of households. Then firms will be doing expenditure on their investment requirement. So they are investing, right? So investment, right? Investment, this is the expenditure of the firm, right? So this is denoted by letter I, right? This is denoted by letter I. And government is doing expenditure, this is known as what? Government expenditure, or you can also call it public expenditure, because government expenditure is also known as what? Public expenditure. So private final consumption, private expenditure, and this is public expenditure, since it is government expenditure, denoted by G, denoted by letter G. And external sector, since we are more concerned with expenditure, then we will be calculating what? Our expenditure is on exports, right? Expenditure is on exports, right? The goods that are produced in our economy, and imports are those goods which are not produced in our economy, and expenditure is what we are doing on imports. And exports, we are earning something, right? We are earning something, so we are subtracting imports from here, and this can be denoted by this phrase also, this equation x minus m, that is exports minus imports, or we can denote it like this, nx means net exports, right? Net exports. When we say exports minus imports, this is known as what? Net export. This is known as net export, right? And when we calculate all these expenditure in our economy, so we get what? GDP. Get what? GDP. So GDP is what? C plus I plus G plus nx, consumption plus investment plus government expenditure plus net exports. This is one of the GDP that we can say. Now, GDP, since all these consumption, all these expenditure we are doing at market prices, so here we get what? GDP at market price. Here we got GDP at market price if we calculate GDP by expenditure method. So this is known as GDP by expenditure method. We are calculating expenditure done by all the sectors in the economy, right? Now, when we calculate GDP by income method or GDP by income method, when we calculate GDP by income method, how do we calculate this? I hope you can recall we discussed operating surplus, etc. So, on factors of production, we get income, right? For example, we get rent, we get wages or salary. So, how do we classify them? First, we classify operating surplus. Operating surplus means what? Rent plus interest that we earn, right? Rent plus interest, and for example the profit that we earn, right? Rent plus interest plus profit. This is for land, capital and entrepreneurship skills. Then we add what? Salary, right? Salary or wages. Salary or wages. And there are people, so we classify this as unit 1, we classify this as unit 2, right? This is what we call as operating surplus, operating surplus, and this is what we call salary or wages. And third component in this can be, the mixed income. For example, there are people who are running a small shop, right? A small shopkeeper is there, and they own the household, they own the land, they own the capital, they own everything here, and they are also not employing they are also not employing people to work for them. They themselves are working, so they are known as what? Self-employed people. Income of self-employed people. So income, here we can write income of self-employed, where the separate data, self-employed, where separate data is not possible, it is very difficult to obtain. So income of self-employed people or households, this is third component, right? When we add all these third 1, 2 and 3, all these components will give us what? They will give us, since it is income, so depreciation is not there, so this will give us net domestic product. Net domestic product. Depreciation is during production, and expenditure, in expenditure also we get depreciation value included in it. Here we don't get depreciation value included in it, so it will give us net domestic product at factor cost. At factor cost. So this 1 plus 2 plus 3 will give us what? NDP at factor cost. This is the GDP version, or the variant of GDP we will get by calculation of GDP by income method, right? Now, if I want to make this with if I want to equate this with previous variant, right, with the variant of GDP at market price, because generally what the GDP value we read in the newspaper, etc., this is real GDP at market price only. So if I want to get this particular variant from this variant, then how I can get this? So if I include the hypothetically, if I am including the value of depreciation, then I will be getting what? If I include value of depreciation, then I will get what? GDP at factor cost, right? This net will turn into G, right? Gross. This net will turn into gross if I add value of depreciation. If I subtract value of depreciation from gross, I will get net value, right? I hope we can understand it. Now, this is factor cost, right? This is factor cost. Now I want to get market price. So how I can get market price? Plus net indirect tax, plus net indirect tax. If I add, then I will be getting GDP at market, GDP at market price. This is what I have got, right? So you follow any method. For example, if I talk about value added method or product method, the third method of calculation of GDP. See, we don't have formulas, etc. We don't have to go into the details of how we are calculating, because these questions are not there in exam. What is there for you in exam, that we will discuss in a while, but I hope you can understand value added method and product method. Value added method, or also known as what, product method. We have already seen how do we calculate the value addition, right? So how do we calculate value addition? Value addition is nothing but, value addition is nothing but what, the cost, the output, the value of output minus value of output minus input cost, right? Minus input cost. This will give you value addition, right? For example, we have seen this example of a tea seller. When we talked about example of a tea seller, we say that this tea includes sugar worth rupees 10 and milk worth rupees 20 and tea powder worth rupees 10. So 40 rupees is the input cost we are having, right? 40 rupees is an input cost. And suppose we are selling tea, we are selling this tea at, we are selling this tea at 100 rupees. If we are selling this tea at 100 rupees. So what is value addition that we have done? So here value addition will be what? Value addition is equal to cost of output, that is 100 rupees, minus cost of input, that is 40 rupees. So value addition done by the tea seller is 60 rupees. Value addition done by the tea seller is 60 rupees. Now you will ask that what is the value addition that has been done by sugar, milk, etc. So suppose, since they are if we are, for simplification purposes, if we are saying that this sugar, milk and tea powder is available in nature, then what will be the value addition by sugar producer, milk producer and tea powder producer? So it will be 10 minus 0, because this is available in nature. 20 minus 0, 10 minus 0. Hypothetically we are taking, we want to simplify this, otherwise there will be some cost for sugar manufacturer also, right? For example, this manufacturing cost of sugar from sugar cane, etc., right? Milk, you are employing this you are using cattle, etc., to obtain milk, so you are having costs, so we will subtract those costs, right? But we can get value addition done by each sector in the society, and when we calculate value addition done by all, value addition by all producers in an economy, all producers, right? All firms, all producers, when we are calculating value addition, this is denoted as summation of gross value added. This is denoted as summation of gross value added, right? So this is one of the method by which we can obtain GDP, right? Now, when we have got this, I want you to understand one more thing here. In India, how do we calculate GDP then? By which method, right? This is also one of the question. If we are having three methods, which method we are using? So we are using all the three methods. Then we have to classify what? Indian economy. The sectoral classification first we have to see. Now we will do sectoral classification in detail at certain point of time. Right now we are not going into the details of it, but since we have to understand that in India which method we are using for GDP calculation, so we will be giving some passing reference for the sectoral classification of an Indian economy. So broadly we can say, if we talk about GDP calculation method used in India, if we say GDP calculation method being used in India, so how do we calculate? So we use all the methods that we have seen so far, right? All the methods we will be using that you have seen so far. Now how? So we can broadly classify Indian economy in two sectors, in three sectors: primary sector, secondary sector and tertiary sector. Primary sector, secondary sector and tertiary sector. I am not going into the details of it as of now, so let's keep it simple only, right? Tertiary sector. Primary sector is about agriculture and allied activities. So it is about agriculture and allied activities, right? So two parts are there. One is agriculture, that means raising crops, for example raising wheat, rice, etc., right? Pulses, these things. Second is allied activities, right? Like dairying, like fishery, right? Like poultry, right? Beekeeping, like sericulture, like pisciculture. These are the things that are included in allied activities. As of now, please don't get involved into this. We will be discussing all these things separately under the module of Indian economy at the eve of independence. Then secondary sector, I have to open it, right? Because different methods are being used here. So for secondary sector, we can say one of the component of secondary sector is mining and quarrying. So mining and quarrying here, I will explain why mining and quarrying is under secondary sector. And then there is industry, that is manufacturing, right? Manufacturing. And then one more sector known as utility services, called as electricity, gas and water supply. Electricity, gas and water supply, utility services, right? And then we have last one, that is construction, right? Construction of houses, construction of buildings, etc. So construction, these are there. And tertiary sector, we will keep it close here as of now, and we will say all the services, right? All the services that are there, they are in under this tertiary sector. Now which method we are using? So we are using for agriculture, or maybe we can use different color so that you can clearly. For agriculture, for mining and quarrying, for manufacturing, right? We are using income product method. We are using here product. Here we are using for electricity, gas and water supply, we are using expenditure method. Here we are using, it depends how easy or how accurate data is available, right? So we are using here expenditure method. And here we are using for construction, and for entire services sector we are using income. They're using income method here. So now you can see that how do we use different methods of calculation of GDP in Indian economy. So primary sector, secondary sector and tertiary sector, as we have seen here, right? Which method we are using for which particular sector. Now since my agriculture and allied activities, we are having lots of input from nature, so it is primary sector. And mining and quarrying also, if you read NCERTs of geography, then you will be studying that mining and quarrying is also part of primary sector, here. But when we classify them in economy, then mining and quarrying is included with refinement, right? And this refinement happens in refineries, right? And refineries are industrial setup, that is why we are classifying them under secondary sector, right? So I hope this is clear now. One more thing we have to understand here, when we talk about secondary sector, this product method. So in product method, what are we doing? Basically we are using a concept of basic prices. So GDP at basic prices also sometimes we calculate. So what are basic prices that we have to understand, right? So basic prices are between, for example, this is just if you want to understand in a way, basic prices are in between factor cost and market price. So here it is factor cost and here it is market price, right? Here it is market price. But we have seen that the difference between market price and factor cost is net indirect tax. So how do we obtain basic prices, that we have to understand. So basic prices are nothing but basic prices is equal to, now we divide this tax, because the difference between market price is equal to what? Market price is equal to factor cost plus factor cost plus net indirect tax. So this net indirect tax is being divided into two categories. One is known as production tax and other is known as product tax. So this is production tax and this is product tax. Production tax and product tax. Now please understand, what do we mean by, what is the difference between production tax and product tax? When we say production tax, it is not applied on the volume of the production that we are doing. No, it is associated with the production activity. For example, the excise duty that we pay on land, right? So whether you are doing any production or not, you have to pay that much tax. So this is not related to the volume of production, so not associated with volume of production, rather are only associated with the production activity. If you are involved in activity, no matter what kind of production you have done, but you have to pay this much taxes. So not on volume, right? We can write not on volume of production, not on volume of production, but associated with production activity, right? Not on volume of production. And product tax, for example, GST, for example, GST that we pay on sale and purchase, right? On sale and purchase. So this is on volume of production, on volume of production, right? On volume of production. This is not on volume of production, rather it is associated with the production activity only. So this will give us what? Basic prices. So basic prices are nothing but what? Factor cost plus production taxes. Factor cost factor cost, and now subsidies can also be there. So factor cost plus net production tax. Net production tax. So basic prices also we use to calculate, right? Mainly in gross value addition method or GVA method. This is net basic prices when it gives how we obtain basic prices from factor cost. This is what we have understood. Similarly, if I want to get market price, if we want to get market price from this, how I can get market price? Because I have already got basic prices, and basic price includes factor cost and net production tax. So basic prices plus net product tax, net product tax, because this is the variety of tax that I have left while calculation of basic prices. So this is how I can obtain market price. This is how I can obtain market price, right? I hope this is clear. Right, now let's understand one more concept here, that is related to gross national product. How do we calculate gross national product? Now, how do we calculate this? Gross national product means GNP. How do we calculate this? Let's understand. When I say GDP, it is a territorial concept. When I say GDP, it is a territorial concept. That means it is talking about the value of production in, it is talking about the value of production that is taking place in the domestic territory of an economy. But when we talk about GNP, GNP is giving us idea about nationals of the country, right? It is not only associated with the domestic territory, rather it is associated with the nationals of the nation. For example, the GDP definition that we have seen just now, that total value of final goods and services produced in a domestic territory of an economy over a period of a financial year. So if I want to modify this definition for GNP, it remains the same here. Total value of final goods and services produced not in a domestic territory. In place of domestic territory, we will write what? By nationals of the, by nationals or ordinary residents we write. So by nationals of the nation, by nationals of the nation, right? By nationals of the nation, right? Of an economy, not of an economy, by nationals of the nation over a period of a financial year. That is fine. So what difference you observe here? See, GDP is about total value of final goods and services produced in a domestic territory. When we talk about GNP, gross national product, it is talking about total value of final goods and services produced by nationals of the country, no matter where, anywhere in the world, that we will account, or that we will consider under this, under gross national product, right? For example, here, if I want to get GNP from GDP, right? We have GDP, we have calculated GDP, we have understood. Now, if I want to get GNP from GDP, then what things I have to include and exclude? Suppose this is domestic territory of India and this is entire world. Right? Now, this is India and this is entire world, right? Now, when I say GDP, I am only concerned about production taking place in this particular territory, right? Or the various, some exceptions also we have discussed, right? In domestic territory, for example, embassies and consulates, etc. So we have discussed some exceptions, but as of now we can focus on this is domestic territory of India, and whatever production is taking place in this domestic territory, no matter by whom, whether Indian national is producing or foreigner is involved in production, no matter who is producing, where it is being produced, that is taken into the consideration while calculation of GDP. But when we talk about GNP, in GNP calculation, here you can see production by Indians. So Indians are in India also, Indians are in other part of the world also, right? And in India there are foreigners, right? In India there are foreigners. So here some group is of foreigners also. Production is being done by foreigners, foreign firms, or foreign individuals, etc. So what we can understand here, right, when we are calculating GNP, in GNP calculation we have to subtract this, because we don't want to include foreigners. We want to only include whom? We want only Indians, production done by Indians. So we have to exclude this. And when we are calculating GNP, so we have to include the calculation of these people also, right? For example, if Indians are working in US, Indians are working in other parts of the world, Middle East and anywhere else. So when they are involved in production activities, they are doing some production activity, so their production should also be included under GNP. So what I have to exclude and what I have to include when I am calculating, when I have GDP, I have to include the production done by Indians anywhere in the world. So I have to add, right, factor income from abroad. So I have to add factor income from abroad, factor income, whatever income you are earning from abroad. So factor income from abroad. But I have to subtract what? I have to subtract this foreigners income in my country, right? All the production that is done by foreigners in my country. So I will be subtracting factor payments made abroad, or factor payments to abroad, right? Factor payments to abroad, right? This is what I have to subtract. So this plus and minus I can call net factor income from abroad, net factor income from abroad. So this is one more concept that we need to understand, NFIA, net factor income from abroad. So in GDP, if I will add this net factor income from abroad, then I will get gross national product, right? Gross national product. So this is the idea of gross national product. Gross national product talks about nationals. Now Indians are present in many parts of the world, so we have to take into consideration their value of production as well, right? So this is all about GDP and GNP. I hope this is fine. Now there is one more small concept, and then we will be able to complete this chapter. That is known as what? Green GDP. That is known as what? Green GDP. Now, what do we mean by green GDPs, right? See, the kind of economic activities that we are involved in, for example, production of goods and services, etc. So in these economic growth, we are harming the environment as well, and our production activities sometimes or many a times result into degradation of environmental whatever environmental wealth we are having. So environment degradation, sometimes it is also resulting into environmental degradation. So economic growth, although more on this we will be studying under our third module related to inclusive growth, but just to give you the concept of green GDP, economic growth is resulting into what? It resulting into environmental degradation, right? Environmental degradation, for example, loss of environmental degradation. More on this you will be studying under environment subject, environment and ecology. But for example, when we talk about environmental degradation, for example, soil degradation, right? Water depletion, soil degradation, water depletion or water table depletion. This groundwater is going down and down, so water table is depleting, so water table depletion. Or for example, this desertification, etc. So desertification or environmental degradation, we can say loss of biodiversity. So desertification, loss of biodiversity. Or for example, we can say this global warming and impact of this glacial melting, etc. All are part of global warming only. So glacial melting or sea level rising, etc. you can include here global warming, that sea level rising. Or for example, this also include this glacier melting, right? Glacier melting, all these things you can include. So environmental degradation, for example, right, you will be studying about this global warming, and major is climate change, right? So these things you will be studying there. So our production activity or economic growth is sometimes resulting into environmental degradation. These are the few examples, right? These are few examples that we will study under the subject of environment. For example, soil degradation, the health of soil is declining, right? The production that we used to get earlier, now because of overuse of pesticides, etc., there are many things. For example, you will be studying about this bioaccumulation, biomagnification of different pollutants, etc., that we will study there. Water table depletion, water level is declining, and desertification. Desertification is not about a land is converted, it has been converted into a desert. Rather, this is a process, and if process as usual continues, that then maybe this land will become a kind of desert, right? Arid, semi-arid area, for example. Those are the things, right? So economic growth is resulting into environmental degradation. So what green GDP says, is the conventional GDP that we are having, we will subtract, we will penalize this GDP, by reducing the cost of environmental degradation that they have done. Environmental degradation, for example, when a flood, etc., we see Kerala flood, for example, in 2019, and other floods also. These days we are witnessing floods in northern part of the country. So we say that this much loss that the flood has caused. For example, flood has caused 10,000 crore loss, right? 10,000 crore loss, 1,000 crore loss. So when we say flood has resulted into these much losses, where this money has gone? So we can understand that this money, we are exploiting nature a lot, and when we are exploiting nature has taken this money, right? So when we say during this particular calamity, natural calamity, for example, and this much money has been lost in this, so where this money has gone? For example, if you say there's Jammu and Kashmir floods, and further floods in Punjab, northern parts of the country, we have seen that these many floods have taken place. So these many floods have taken place, and these many floods have resulted into thousands of crores of loss. So where this thousands of crores of loss has gone? So maybe we are exploiting nature a lot, and nature has taken its cost back. That is known as what? Environmental cost of environmental degradation. And when we are calculating green GDP, so GDP minus environmental degradation plus there are the cost of, or the ecosystem services. So the value of ecosystem services. Now this I am not going into the details of it, because you will be studying it under the different subjects. But value of ecosystem services, what do we mean by value of ecosystem services? For example, ecosystem, these plants, etc., these for example forest, etc., they are involved in they are giving lot of services to us. For example, provisioning services, they are provisioning water to us, they are provisioning this food in the form of fruits, etc., and in other form of eatables. So we are having some foods also available from ecosystem. One is provisioning services. Then we are having regulating services. For example, when the availability of forest, etc., is resulting into what? Pollination activity, right? One of the important activity that we understand. So pollination. Then we are also talking about cultural activities that are there. Cultural activities, for example, a beach is there, and when you go there, creational activities, right? For example, cultural and creational activities. For example, you are under stress and you are going to a particular beach or a lake, etc., and you are getting relaxed, you are releasing your anxiety, pressure, etc. So this is also one of the service that we are obtaining from ecosystem. And then we are having different other services as well. So these are the ecosystem services. So we add value of GDP, we add the value of ecosystem of the country into GDP, and then we get green GDP. But since you can understand this, that there can be lot of issues with calculation of this, because estimation of ecosystem services, sometimes this is not that easy, and cost of environmental degradation is also sometimes not that very easy. So green GDP remain a theoretical concept, although European countries and developed nations are working on it. But in India, as of now, we are not having official estimate of green GDP by Government of India, that we are using this Ministry of Statistics and Program Implementation. But many efforts are there in this particular direction, right? So here we conclude chapter on GDP. Although see, one topic cannot be completed at any point of time, right? There is a lot that we can discuss, but we have to limit somewhere ourselves, right? We have to limit ourselves somewhere. So we are limiting ourselves with respect to national income here, and in the next class we will be discussing inclusive growth, right? So thank you very much. Take care. Bye bye.